Dear participant, in Module 4, we discussed the different way of doing and procuring a PPP. And this was to give you a good idea about how the 6 steps to procure the PPP. In Module 4, it was the overall process and procedure. Now we're gonna focus on how to finance public-private partnership. This is one of the most complex module. This is also a very difficult challenge for most governments. I will spend some time to explain the different model. So bear with me. This is not anymore about justification why we are doing a PPP, what is a legal framework, or what the process involved. Now we are in the core of the issue, because if we are not able to raise capital and structure properly and find some money, we cannot have a PPP project. So what we're gonna do today in this session is to zoom on the specificity of the alternative financing model. 3 main sections are covered in this model: the financing structure for public-private partnership. It shows way private financing of PPP can be structured. Then we're going to look at the consideration for the government. In other way, how the government look at this project. And we will highlight ways government may need to enable or control how the private sector raise that fund. Because it's always a mixture of debt and equity. So the question you will ask, we have to ask ourselves, how much debt we're gonna raise? How much equity we'll put in this project? 20%, 30%, 10%? If you go with 20-80 structure, in other words, 20% equity, 80% debt, how you'll finance that debt? How you raise money from that debt? Are you gonna raise it from the international financial institution? What will be the cost of the debt, etc., etc. These are very important considerations for the government. Then we'll have a quick look at the role of the public finance and public-private partnership. Because as we said, PPP is public-private partnership. So what the public will put here? In other words, what are we going to ask the Minister of Finance to allocate for this project or that project? The party the private party to most PPP contract is a specific project company that is usually created. When you talk about the private sector, you don't talk about person or private company that exists overseas. We talk about the creation of special purpose vehicle, which will become the project company that will raise finance through a combination of equity provided by the project company shareholder and debt provided by bank or through bonds or through financial instrument. So the special purpose company will have to raise money. And that's why the first thing the private party to your contract will do is to create this SPV. The financial structure is the combination of debt and equity, as we said so far. And it's a contractual relationship between the equity holders and the lender. The government primary contractual relation is with the SPV, which is created in your country. Since equity is more expensive than debt, shareholders usually use a high proportion of debt to finance the project. And that's normal. That's why the question will be how much equity the private sector will put. Usually it's 20. I've seen 30, but in some low-income countries, I've seen 10% as well. The financial modeling that we discussed in the previous model will provide you and tailor the debt service based on the project future cash flow. In other words, the financial model that you will develop, that we discussed earlier, is important because it will help you figure out future cash flow based on different inputs. Now, let's go through a typical PPP structure, and let me walk you through this. If you look at this graph and you have the sources, it's coming from the PPIF database, and as you see, the center of it is the project company, the SPV. Here, the government primary contractor relation is, as I said earlier, with the project company. They may be complemented by a direct agreement between contracting authorities and lenders, as you see here. Also, often this relationship is limited to the provision in favor of the lender included in the PPP agreement, such as step in right or senior debt repayment guarantees. So the initial equity investors who develop the PPP proposal are typically called project shareholders. Typical equity investor may be project developers, engineering or construction company, infrastructure companies, and private equity funds. The lenders that you see here in this table to PPP project developing country may include commercial banks, multilateral and bilateral development bank, and finance institution, and institutional investors such as pension fund and insurance companies. The project company contract with the firm to manage design and construction, usually known as engineering, procurement, and construction, what we call here the EPC contract, and operation and maintenance. This contractor may be affiliated with the equity investors. And that's an important aspect. So you see the combination of operation management contractors, EPC contractors, linked to the project company somehow, the project company getting the lender and equity investors that run it, and then you will have the government who has a direct agreement with the government contracting authority. And through the PPP contract, has a relation with the project companies. Now, once we have looked at the structure, the question will be what kind of flow of fund the project structure function. That's how it looks. Equity investment is first in and last out. That's in any project losses are borne first by the equity investors. And lender suffers only if the equity investment is lost. This means that equity investors accept a higher risk than debt provider and therefore require a higher return on their investment. The aim of the project shareholders and their advisors is developing the finance structure to minimize the cost of finance of the project. As we said earlier, because equity is more expensive than debt, project shareholders use a high proportion of debt to finance the project. In each country, this could be different, but as I said, it could be between 10 to 30% of equity injection, and the rest will be in debt. The financial modeling for the project will have to tailor, once again, the debt service and expected dividend and rate of return according to the expected flow of funds, including revenue from users' fee, government payment, and construction ongoing expenditure, namely for maintenance and operation. So as you see in this chart, the relation again between the project company, the EPC contractor, the service payment, and the way it is the project company is financed through bond, loans, debt service, and how the equity investor inject investment but in return expect dividend is important. But what is very important is that the users who are supposed to pay for the service they are receiving, pay a user fee to the project company because the project company is providing them a service. It is very important to ensure, therefore, that the quality of the service provided by the company is of high quality. On the other hand, we need to ensure cost recovery. Therefore, the pricing structure and what the user fees and what the citizen will pay will ensure that the project company could be run on an efficient basis and receive the fund needed and not have to receive additional subsidy from the government. The more you go toward a cost recovery process, the less subsidy will come from the government, and the more the service will cost to the users. This is now, let me talk to you now about the financing structure for the PPP and what type of financing based on private partner exposure. We usually talk about non-recourse. You will hear that in project finance a lot. It means lenders paid only from company project revenue without demanding compensation from equity investors, and the equity investors have limited liability. Then you can go with full recourse corporate finance, where the lender's recourse in case of default of the project is on the balance sheet of the parent company, and where the private partners has unlimited liability toward the lender. If a major holding company from overseas is directly involved in the project, it will be called full recourse corporate finance, and the mother company will be then accountable on their balance sheet. However, if the mother company, the holding company overseas, has created the project company, the SPV that we explained earlier, then it's the responsibility is within the project company and the revenue generated. And that's what we call the non-recourse. We have also what we call limited recourse project finance, when the lender recourse in the case of default is limited to the cash flow generated by the special vehicle company, but does not include the balance sheet of the initial equity investor. And that's also the difference between the first model and the third model. So non-project finance for PPP, and we've seen a lot of them around the world, and the non-recourse project finance, lender can be paid only from the project company revenue. That is the project company that is supposed to create the cash flow. And the project finance structure here typically involves a large proportion of debt, and in many cases, it ranges from 70 to 90%, 95% of total finance, as I explained earlier. From the equity investor's perspective, this helps manage risk by limiting the exposure to a project and make it possible to undertake much larger project than would otherwise be the case. For lenders, it means undertaking rigorous due diligence, focusing on the project cash flow and the contractual structure. In addition, since PPP financing is actually quite diversified, in some countries with less developed financial institutions, and that's an important aspect for you, I think, where project finance is not common, but where contracting authority wish to design good PPP arrangement, you have to create your SPV, which then obtain loan with guarantees from the PPP company shareholder. And I think this is a question that I am sure you are debating in your country. You are in the process of developing your financial institution. You have the willingness to do PPP. You don't have the bank that could be financed all this PPP. So what do? We strongly recommend in this case that you require the creation of a PPP company, the SPV, as a good process, because the SPV will be backed by PPP company shareholder and will be able to help alleviate the lack of financial sophistication or development or tools in the countries. In countries with more developed financial market, or as you develop your financial market, large investors do finance the PPP project with their own resources, obtained through full recourse finance. And later, after construction is completed and construction risks disappear, they issue project bonds to the financial market. We have seen many of this in the United States. We've seen many of this in Europe. Most of the PPP projects are done that way. So if we look now at the structure of the non-recourse and full recourse project financing structure, as you will see here, we'll have the lender on one side, which provides a loan to the shareholder. The shareholder is supposed to pay back to the lender principal plus interest. There is a cash flow generated from the PPP project that will go back to the shareholder and the borrower. If you look at the left side, we have the project company where there is an SPV borrower, and this is when we have a less sophisticated financial market, which again provide financial flow to the PPP project to happen. In return, you expect a cash flow to return to the project company. The project company, the SPV, who received loan from the lenders, expect also some to provide principal interest paid back to the lender. And within this, the shareholder, the mother company, has an equity participation in the SPV, because that's where the holding company can do it. In other words, what you see in front of you is the two models for a less developed financial market and for a more sophisticated development market. In some cases, a project company may be unable to raise finance on non-recourse basis. One option is for a major project shareholder to provide a partial or full guarantee of the project debt. For example, in 1997, a concession for the eastern section of the Metro Manila was awarded to the Manila Water Company, a consortium led by the Ayala Corporation of the Philippines, with interest from the United Utilities, Bechtel, and the Mitsubishi Corporation. In the wake of the NH financial crisis at that time, the water company was unable to raise debt to finance investment on non-recourse project finance basis. So Ayala was able to step in and provided a corporate guarantee to back up the project company. Another example, in 1992, an oil pipeline in Colombia was being developed as a joint venture between the National Oil Company and the international company, with the IFC, which is the private arm of the World Bank, as the main lender. At that time, the IFC was concerned about possible attack from the guerrilla, and this project stalled. To move forward, the shareholder provided a full loan guarantee on the project, and then the project was able to be implemented. So we look at the financial part, recourse, non-recourse, and alternative models. Now let's come back on the consideration for the government. When a PPP primarily involves private finance, the investor is typically responsible for developing the financing structure. However, many governments may need to influence the design. They still think this is a public good, and therefore it's important to have their input. The responsibility for the government, in my opinion, should include, first, ensure bankability of the project. We've seen too many projects put on the marketplace that are not bankable, that are not attracting investors. That's what we call sometimes huge project beyond the ambition of the country, and then they die before they are implemented. So before a government put the project forward, you have to ensure that this project could be financed and bankable and attractive. Then limit debt financing to allow to ensure risk transfer should not be undermined. then you have to ask yourself how to manage risk going from contract award to financial close. And that's an important nuance that we would like to bring here. Sometimes in the bidding document, when the requests for proposals are issued and the offers from the private sector came, they will tell you, we have been able to talk to the bank are ready to give us financial support for debt financing. The international financial institutions are ready also to give us guarantees. There are a lot of promises, and sometimes backed up by comfort letters, what we call. But comfort letters, it doesn't mean guarantee. So how you manage between the time you award the contract and the operator and the investor and the SPV created is able then to go to financial closure. Financial closure means I got all the debt, I was able to put the equity. This process between the award and financial close could take between 6 and 12 months sometimes. And it's very important that you make sure to ensure that the SPV or the contractor follow due process and provide you the information needed. You might also need to follow from your side and do your own due diligence. Another question, how to deal with refinancing project debt. We've seen in many projects that sometimes you refinance your debt because you can get better rate. It's like a mortgage here. How to deal with it? Because the private sector will tell you, after 5 years in implementing the project, will tell you, listen, I have a better deal from IFC, from the Asian Development Bank, or from a bilateral or export credit agency. I would like to refinance my debt. How to deal with that? How to define step and right for lenders and government. And that's again on the legal regulated setup of your country, question that you have to ask yourself. So bankability, to come back on each of these items, refer to the ability of a project to raise finance. If too much risk are given to the private partner, the lenders will reduce the amount prepared to lend. Therefore, when structuring the PPP, government must ensure the project is bankable and resist any pressure to take more risk than necessary. Don't go with lending for optimism approach, I would call. I used to tell this to my client. You have to be very realistic. When you have limiting the amount of debt, you need to ensure that project shareholder, which prefer higher debt to equity ratio, since equity is more expensive, as I said, and easier for a project to raise debt than equity, you need to avoid that the government can set a minimum requirement on equity level. It is very important that government have an idea how much you expect equity to really avoid any of the uncertainty that could be created. As I said earlier, project shareholder prefer more debt to equity. But you need to make sure that the private sector put their own money at risk. And that's why equity is important. And this is ensure that the core group of equity investors are exposed to the project risk and also are really accountable and ensure the facility is created based on conceptual standard in a timely manner. The government uses tools at its disposal to mitigate risk of the project being delayed or for different problem of securing financing. Bidder may have to provide a bond, and usually I recommend that you ask for a bond, which might be called on if the bidder failed to achieve financial close in a certain period. These kind of bonds usually are requested at the process of request for proposal. This can also encourage bidders to develop concrete financing plan prior to bid process and also to show their willingness really in their seriousness in this project. The government may only accept this with financing in place. That's one option. The lender must complete due diligence before the tender process is complete. That could be another approach. But once again, if you are new in the PPP project and you would like to invest in developing the sector, in attracting investors, in developing trust in the marketplace, you have also to manage your expectation. The private sector may not come with full financing in place and may require you to provide guarantees. It depends also on the choices and the speed and the way you would like to attract the private sector. The government may develop and provide a pre-arranged financing package for the project to the bidders during the tender process. When the winner bidder has the option to use that financing package or not. I've seen that. The government will say, this is a financing package. I was able to get a loan from the World Bank to finance some of the debt for ancillary aspect of this project at a very good rate. I was also able to receive a guarantee from a bilateral donor. I was able to get some grant money, and this is a financial package that you should consider. Here, the private sector will look at it, will look at his financial model, will see if it fits or doesn't fit. If it's more bankable, cheaper, probably they will go with it. So all of it, part of it, it all depends. But that's another option that you can also think as government when you look at the financial proposal. Now, refinancing of the debt project. The government has tools at its disposal to mitigate refinancing risk a private partner may face. One way of doing so was by take-out financing, where a second lender promises to take over a loan at some time in the future, encouraging the original lender to provide long-term debt. The private partner could also stand to gain from refinancing options in case loans are available at better term at the time of refinancing. In such a case, the government could include a loan for how PPP refinancing benefit may be treated, the ratio in which refinancing benefit are shared between the public and private partnership, and the way this will happen. That's the way you have to think about it when you refinance project debt. Lender requires step in right when the project company failed to meet debt service obligation, or if the PPP contract is under threat of termination or failure. We have seen in some cases, after 10 or 15 years, trouble in some contract, where either the government decide to terminate the project, or private sector will decide to give away and leave that contract because they are losing money, the relation is bad, etc., etc. Lenders generally negotiate the step and condition of the contract with the government. And the government and the lender need to have a clear framework and timeline for invoking step in right. You may not invoke those stepping in right, but you need to have a process just in case. Predictability is important. After we discuss the financial modeling, the role of the government, what about the role of the public finance in PPP? And that's an important question. How much public finance should be involved in a PPP project? You can decide also to partially finance PPP in addition to private finance. Reason government to provide finance for PPP, avoid excessive risk premium, mitigate government risk, improve availability or reducing the cost of financing. And frankly, sometimes some government will be able to raise money from the international financial institution, like the World Bank, the Asian Development Bank, or receive grant from bilateral financier at a better rate than what the private sector will do. And therefore, in the 3 PPP, we can envisage that the public finance could come from the private sector, public sector as well. But it has to be done within a framework of partnership. Government may finance the PPP through the budget also. They say we have enough success. We succeeded in stabilizing the macroeconomic situation of the country. We have some good budget now. We can provide grant subsidy. This kind of decision are being taken usually by the Council of Ministers. The willingness of the public sector to provide funds can also act as a signal to help build private investor confidence. And I've seen it actually. The public sector sends signals that they are ready to put money on the table. This makes the project more bankable and gives some good signals to the private sector that you are serious about the project. And that's an important aspect to keep in consideration. Instead of providing direct funding, the government can also provide debt repayment guarantees. In guaranteeing project debt undermine risk transfer to the private sector, since the risk of repayment is now with the government. Therefore, government only should provide partial risk guarantees. And those partial risk guarantees can also be provided by the international financial institution. What I like with the partial credit guarantee is then when they are provided as part of a project where the partial risk guarantee is guaranteeing non-commercial risk, it helps the private sector to raise money, extend the maturity of the debt, and reduce the cost of borrowing. And that's for the partial credit guarantees provided by the World Bank and other organizations is an important element when you would like to make the project bankable, feasible, and where you can reduce the cost of borrowing. These are references, links for more detail on this model. In conclusion, this aspect of the PPP is one of the most difficult aspects. I'm sure this presentation, which was very concentrated, provided you some framework, but also you have a lot of questions in your mind. My recommendation is to go again through it, step by step, look at each of the slides and the element I have provided you, and really try to absorb the different way of financing, the different way of dealing with issues, and to ask yourself, what's the role of the government versus the private sector in this kind of structure? As we move to the next step, we will have case studies where you will have to apply some of those conceptual frameworks that we identified in the first few models, and then you have to define a financial structure of what kind of PPP exercise you would like to do to start implementing some of those ideas and get at ease with some of those concepts. Thank you.